Welcome back to Investing Talk Podcast. Today we're tackling a question that seems to be on quite a few minds. Is Korea Electric Power Corporation, KEP, a good time to buy right now? Our goal here is to walk you through a pretty thorough analysis of KEP. We'll be digging into the financials, market data, expert opinions, really trying to give you the full picture. Before we jump in, though, if you find this analysis helpful, please do remember to subscribe, like, maybe leave us a comment. Your support really helps us keep going, so maybe consider buying us a coffee, too. And, hey, if there's a specific company you'd like us to look into next time, just drop its name in the comments below. We do read those.
Yeah, it's a great one to look at today. KEP is, well, it's a really interesting case, not just because it's South Korea's biggest utility, but, its relationship with government policy is so central. Evaluating something this regulated always means balancing what looks like maybe deep value against some really significant risks. Risks that aren't always obvious. This isn't your typical growth stock, definitely not. Understanding that tension is, I think, key here.
Okay, let's unpack this then, starting with the basics, the fundamentals. How does Korea Electric Power Corporation look just in terms of its basic financial health? What are the numbers telling us? Have things genuinely improved?
Well, they have, actually. If you look at the top line, KP's trailing 12-month revenue, the TTM, it's sitting pretty solidly around, say, $69 to $71 billion. Impressive scale. And probably the biggest news, certainly for investors, is the net income, about $4.6 to $4.7 billion. That's a huge turnaround, really. It signals a significant rebound because they got back to profitability in 2024 after some pretty tough losses before that.
Right, that rebound definitely catches the eye. What drove that? What pushed them back into profit?
It really boils down to two main things: government reforms and, crucially, improved electricity tariffs. For a utility like KP operating in such a regulated space, those policy decisions are, well, they're everything. Right now, their gross margin is around 15.26% respectable, and net profit margin is 6.61%. These numbers are definitely good news, especially given where they were. But, we need to put that profitability into context.
Okay, so it's a positive shift, but maybe not a sign that explosive growth is just around the corner.
Exactly. That's a good way to put it. KPP getting back into the black, it's less about some new era of, massive market-driven expansion. It's more like a necessary adjustment by regulators to keep the utility stable, solvent. Think of it less like a high-growth tech stock and maybe more like a carefully managed essential service provider. It's built for stability, for powering a nation, not necessarily for maximizing shareholder returns at all costs. That future growth rating we see, like 2 out of 6, that's not really a shock. It almost feels like the built-in limit for utilities so tied to national policy.
Yeah, that makes sense. A very different kind of beast. But okay, profitability's up, that's good. But we have to talk about the other side, the financial health, which, looking at the metrics, seems like a major red flag for KPP. The numbers look pretty concerning, don't they?
Oh, they certainly do. The debt-to-equity ratio is frankly staggering. It's sitting at 302%. Just think about that. For every dollar of equity, there's over $3 of debt. That's extremely high leverage. It immediately gives KP a score of basically 0 out of 6 on most financial health checks. And we've also seen their asset base shrink slightly, negative asset growth TTM of minus 4.39%. Not ideal.
Wow, 302% debt to equity. That is a huge weight. What does that actually mean in practice, day to day, for a company like KEP Equity?
It means their stability is really, really dependent on things outside their direct control. Cash flow becomes super sensitive to those government decisions on tariffs we talked about. Any negative shift there directly impacts their ability to pay down that debt. Plus, they're heavily exposed to, global fuel prices, coal, LNG. Those swings hit their costs hard. So this debt level, it just reduces their flexibility, makes them vulnerable if interest rates go up. And basically, it puts their financial fate largely in the hands of policymakers and commodity markets. It's a major vulnerability.
That vulnerability sort of leads us right into its market position then. How does KEP stand, competitively speaking, especially given its unique national role?
Competitively? Well, KEP is an absolute giant. It's the backbone of South Korea's energy system. It's the biggest electric utility, dominant in generation, transmission, distribution, both at home and increasingly internationally, too. They have a diverse portfolio, nuclear, fossil fuels, renewables are growing, and it's just critical infrastructure. This basically gives them a monopoly-like competitive advantage. There's no real alternative at that scale.
So, indispensable, a titan. But you hinted earlier there's a flip side to that, especially for investors looking for returns.
You got it. Exactly. While being indispensable gives them that sort of moat, that competitive advantage, here's the catch. That advantage often serves the country's energy security, the public good. maybe more than the shareholder's wallet. It's like a regulated monopoly. Indispensable, yes, but profits are tightly managed by political considerations, subject to constant government oversight, energy policies, which leads to the big question for anyone investing. How much does that dominance actually benefit you, the shareholder, when profits are so controlled? The market sees this, by the way. It understands this limitation, and that definitely feeds into the valuation we're about to discuss.
Right, and this is where it gets really fascinating, isn't it? Given all that context, the profit rebound, the huge debt, the regulated monopoly status, how does KEP actually stack up on valuation? Does it look cheap?
Yeah.
Or is it cheap for a reason?
Well, looking purely at the ratios, KEP definitely makes you look twice. Its price-to-earnings ratio, the PE, is incredibly low, just 3.79. That directly reflects the recent profit jump after those earlier losses. And looking forward, the forward PE is even lower, 2.94, which suggests analysts, even with their hold ratings, expect profits to continue, at least in the near term. And, while PS isn't the main metric for utilities, if you take the market cap around $18 billion against sales of $69-71 billion, you get an implied price-to-sales ratio around 0.26, which is, again, very low for the sector.
Yeah, those numbers definitely screen value, especially for a company this size. But why? What's behind that extreme discount compared to other utilities? Is it genuinely a bargain, or is there something else going on?
That's the core tension, isn't it? The numbers do scream deep value, particularly next to peers who often trade at much higher multiples. It tells you the market isn't fully buying into the current profitability level, and that's likely because of, well, its history of losses and those ongoing, ever-present risks we've discussed, the debt, the regulation. There's a big discount baked in because of that history and those structural issues. The market's essentially saying, yeah, it's profitable now, but how long will that last? And how much can profits really grow under these constraints?
And we've seen independent ratings reflect this too, right? Sources like Simply Wall saying give it a high valuation score, like 5 out of 6, suggesting it looks cheap compared to peers. But is it truly undervalued, or could this be, a classic value trap because of those big risks lurking underneath?
That's the million-dollar question, isn't it? While comparing it to other utilities using relative valuation certainly makes KEP look undervalued right now, we do have to admit that traditional discounted cash flow, or DCF models, they're pretty tricky to apply accurately to KEP. That's mainly because forecasting future earnings is so difficult when they depend so much on policy changes. And of course, that constant regulatory risk. Projecting stable, long-term cash flows is just really challenging, even if it looks cheap on paper today. So cheap definitely comes with a big, bold asterisk here.
That makes total sense. Okay, let's pivot then. Let's look at the technical side. Beyond the fundamentals, what's the price chart telling us about KEP's recent momentum and maybe where it could go next?
KEP's chart shows quite a journey recently. It's currently trading around, let's say, $13.77 to $13.93. But look at the 52-week range, $6.68 on the low end, up to $15.19 on the high end. That wide range tells you immediately there's been a huge recovery from the lows we saw in late 2024. Buyers definitely stepped in and pushed it up significantly. Looking at levels now, we see key support around $13.33. That lines up nicely with its 50-day moving average. And on the upside, resistance seems to be kicking in around that $15 to $15.19 area.
So a strong run-up, and it's now bumping against the top of that recent range. Does that suggest it's gotten ahead of itself, maybe overbought, or could there still be more room to run?
Well, it is near the top of the recent range, but technically it's not really in overbought territory yet, based on standard indicators. The recovery itself has been strong, consistent, good upward momentum. But hitting that resistance level now suggests we might see some consolidation, maybe a bit of a pause, a sort of tug of war between the buyers who drove it up and sellers taking profits or betting it won't go higher just yet. It feels like a decision point on the chart after such a big move up.
And what about the specific technical indicators? What story do they tell about the trend and the overall market sentiment right now?
Well, the main trend is definitely up. That's clear from the moving averages. The stock's well above its 50-day average at $13.33 and way above the 200-day at $9.48. That confirms the positive longer-term momentum since late 2024. But here's where it gets interesting. The RSI, the Relative Strength Index, over 14 days, which helps gauge overbought, oversold conditions, it's currently around 38.7. Now, that actually leans a bit towards the oversold side, but it's not a strong signal. It's not screaming buy now. It suggests there's still maybe some caution, some hesitation out there, despite the obvious uptrend on the price chart.
Okay, so not a full steam ahead bullish signal then, more like a cautious climb.
Exactly. The uptrend is clear from the moving averages. That's positive. But the RSI not being strongly oversold, combined with some short-term sentiment gauges, still showing a bit of fear. It points to, yeah, cautious optimism. It's not like everyone's piling in without reservation. Buyers are clearly active, but there's enough doubt or worry lingering that the price isn't just exploding upwards without pause. It shows the market is still actively weighing that recent recovery against KP's underlying, well, baggage.
Right, okay. Moving beyond the charts and the core financials, what else is going on around KP? Any recent news, upcoming events that could, shake things up a bit?
Sure. Looking ahead, the Q2 2025 earnings are expected to come in around $0.60 per share. That release will definitely be watched closely. The analyst consensus, broadly speaking, is still hold. Their average 12-month price target is around $14, which from current levels actually implies maybe a tiny bit of downside, suggesting analysts aren't expecting huge gains soon. They seem to be waiting. Although, interestingly, we did see one quantitative smart score model rate the stock as outperform, giving it an 8 out of 10. So, bit of a disconnect there. News sentiment overall feels pretty neutral, maybe leaning slightly bullish if you look at social media chatter, definitely mixed signals.
Huh, that is interesting. Analysts are cautious, but some quant models and the retail crowd seem more positive. What does that difference tell us about how people are viewing KP's future?
It really highlights the uncertainty, doesn't it? There isn't one clear story everyone agrees on for KP right now. You have traditional analysts likely focusing more on the long-term fundamentals, the debt, the regulatory overhang, hence the caution. Then you have quantitative models possibly picking up more on the recent profit recovery and those deep value metrics. And social media often reflects shorter-term trading buzz or maybe a more speculative views. This split just underscores that KP is a real battleground stock at the moment. Different people are weighing its pros and cons very differently.
What about the insiders or the big money hedge funds? Are they buying in, or is it mainly retail driving things?
Yeah, that's telling too. We haven't seen any significant buying from insiders or hedge funds recently. Actually, hedge fund holdings have reportedly decreased a bit, so institutional money seems cautious, maybe even stepping back slightly. But that contrasts sharply with retail sentiment, which seems quite positive. We're seeing a very positive crowd wisdom score recently. So again, that split is clear. Institutions are wary. Retail seems more optimistic.
Okay, so with all these mixed signals swirling around, what are the key things, the potential catalysts that could actually move the needle for KP stock price in the near term?
Number one, without a doubt, is that Q2 earnings report. It's expected around November 14th, 2025. That's a big potential volatility event. Any surprise, up or down, could move the stock significantly. Beyond that, any government announcements are critical. Anything about tariff adjustments, subsidies, broader regulatory changes, that's huge for KP. Remember, policy often matters more here than operational tweaks. And then, of course, external factors like big swings in global fuel costs, coal, gas, or major currency movements, especially the Korean won versus the US dollar, can directly impact their costs and reported profits.
And thinking a bit further out, what about longer-term catalysts? Are there any bigger shifts on the horizon that could fundamentally change the game for KP?
Longer term, you could potentially see more energy market reform or liberalization in South Korea. That could change KP's entire operating environment. Maybe more competition, maybe new opportunities, hard to say yet. The global push towards renewables will continue to shape their generation mix and investment priorities. That's a definite trend. You can never rule out M&A in the energy sector, though KP's size and government links make it more likely an acquirer than a target, probably. And then there are the big macro factors. The health of the South Korean economy, global commodity cycles, evolving climate policies, even regional geopolitics. All those play a background role.
It really sounds like KP's near-term fate, especially, is just so tightly linked to government policy. They really hold the cards.
Absolutely, more so than for many other large companies. KP's immediate future, even its medium-term prospects, hinge heavily on policy and regulation. Government decisions on tariffs, on energy strategy, on reforms. Those are likely to be the main drivers of the stock price, arguably more than typical earnings beats or misses. Investors here really need to watch political developments in Seoul just as closely as they watch the financial statements.
Okay, no investment comes without risk, and we've touched on several for KP already. But let's summarize them clearly. What should listeners really be aware of, the potential downsides?
Right, let's be clear on the risks. Stock-specific, number one, is that massive leverage, that 302% debt to equity. It just makes KP incredibly sensitive. If interest rates climb significantly, or if their margins get squeezed, maybe fuel costs rise, but tariffs don't keep pace, that debt becomes a huge problem, fast. Then there's the regulatory risk, which we keep coming back to because it's so central. KP's profits are fundamentally tied to government decisions. It limits their upside, introduces uncertainty. They don't fully control their own destiny, financially speaking.
And you mentioned the dividend earlier, too. Utilities often attract investors looking for income. But KEP doesn't seem to fit that mold.
No, it really doesn't right now. The dividend is minimal, just 0.05 cents per share, which works out to a yield of only about 0.35%. That's way, way below what you typically expect or want from a major utility company globally. Many peers offer much higher, more reliable yields. This low payout offers almost no income cushion against the other risks, the policy risk, the debt risk. It makes it less appealing for income investors, definitely. It reflects where their cash needs to go servicing that debt.
And what about risks beyond KEP itself? Broader market or sector risks?
Well, KEP is certainly exposed to volatile international energy prices. Big swings in coal or LNG directly impact their costs. There's currency risk, too, given their international dealings and how results are often viewed against the dollar. And while utilities are often considered defensive, a major market downturn or a sharp slowdown in the South Korean economy could still hurt the stock, even if people always need electricity. It's not immune.
When you lay it all out like that, the regulatory risk just seems paramount, doesn't it? It overshadows so much else.
It really does. It's the defining characteristic, I'd say. And it forces that critical question for any potential investor. How comfortable are you putting your money into a company where the government effectively sets the profit potential and where the dividend provides very little compensation for taking on that political risk? It's the fundamental challenge with KEP. Its value proposition is deeply intertwined with national policy, not just market forces.
Okay, so let's try to bring this all together. We've looked at the profit rebound, the massive debt, the market dominance, the valuation metrics, the technicals, the mixed sentiment, and these significant risks. What's the final verdict? What's the overall investment thesis for KEP right now?
All right, weighing everything up, our overall assessment for KEP comes in at a 6.5 out of 10. Here's why. On the one hand, KEP offers genuinely compelling, deep value metrics. That super low PE, the recent return to profitability. It looks very cheap on paper, especially for value investors who think the market has overreacted to the risks. However, and it's a very big picky too, however you have the extremely high leverage, that 302% debt number is a constant concern. You have significant, unavoidable regulatory risk dictating profits, and you only have moderate growth prospects baked in. Technically, the chart shows recovery and consolidation, but no screaming buy or sell signal right now. We also don't see any major game-changing catalysts on the horizon, short or long term, aside from potential policy shifts. And finally, that tiny 0.35% dividend yield just makes it far less attractive than many global utility peers for income.
So definitely a mixed picture. A 6.5 out of 10 reflects that complexity. What does that suggest in terms of how someone might approach this? Is it a long-term hold or more of a trade?
Given all those factors, our view is that KEP looks more suitable for short-term trading than as a long-term core investment right now. There might be opportunities to trade it around specific events, earnings reports, yes, but especially any significant policy news coming out of the government regarding tariffs or sector reforms. An active trader might find plays there. But for a buy-and-hold investor looking for steady capital growth or reliable income, the structural debt burden and the sheer weight of regulatory uncertainty really diminish its appeal at this point. It's a complex situation, requires careful handling, and a very clear understanding of just how much politics plays a role here.
A fascinating breakdown. So the final thought for you, our listener. Given KEP's unique mix of apparent deep value and undeniable deep risk, where do you personally draw the line between an opportunity and maybe just a gamble in such a heavily regulated market? Definitely something to mull over. Thanks so much for joining us for this analysis on Investing Talk podcast. We hope you found it useful, and we'll catch you next time for another look into the markets.